Most people think about money in terms of individual purchases rather than accumulated systems. A person spends $500 on restaurants, subscriptions, small upgrades, convenience services, online shopping, vacations, or financing payments, and each decision feels isolated from the next. The brain experiences the expense emotionally in the present moment, not mathematically across decades. This is one of the most important psychological blind spots in modern finance because recurring spending rarely feels dangerous while it is happening. Small monthly expenses blend into ordinary life so smoothly that they stop feeling like financial decisions at all. The strange part is not that $500 matters. Most people already understand that saving money is important. The strange part is what repeated behavior becomes once time and compounding begin interacting with it. Financial systems amplify consistency much more aggressively than intensity. A single large financial decision may feel emotionally significant, but repeated monthly behavior often shapes long-term outcomes far more powerfully. This is why two people with similar incomes can arrive at entirely different financial realities 20 years later. The difference is not always intelligence, ambition, or work ethic. Often the difference comes from invisible recurring habits repeated quietly in the background while daily life continues normally. At first, $500 per month does not appear transformative. In many cities it barely covers rent increases, transportation costs, or routine consumption patterns. Someone looking only at the present month sees a relatively modest amount of money. But financial systems do not evaluate money monthly. They evaluate money cumulatively across time. Inside this equation is the hidden mechanism behind long-term wealth accumulation. The future value of recurring investments depends not only on the amount contributed, but on time itself becoming productive. Most people focus emotionally on the contribution size while underestimating the exponential role of duration. Imagine someone investing $500 every month into diversified long-term assets for 20 years while earning a historically average market return. The total contributions alone would equal $120,000. But the final value would likely be substantially higher because investment growth begins generating additional growth over time. This is where compounding becomes psychologically difficult to understand. Human intuition evolved around linear relationships. If effort doubles, people expect outcomes to double. Exponential systems behave differently. During the early years, progress appears almost disappointingly small. The portfolio grows, but not fast enough to create emotional excitement. Then gradually the accumulated base becomes large enough for investment growth itself to become meaningful. The early phase feels slow because contributions dominate the system. Later phases accelerate because returns begin compounding on top of previous returns. Exponential curves always appear harmless before they become dramatic. This pattern appears across finance, technology, population growth, debt accumulation, and economic systems generally. The beginning rarely looks impressive. The acceleration becomes visible only later. This delay creates one of the most dangerous behavioral problems in personal finance. People naturally expect immediate feedback from sacrifice. If someone skips purchases repeatedly while seeing little visible progress, the brain begins questioning whether the behavior is rational at all. Modern consumer systems intensify this problem because spending creates immediate emotional rewards while investing delays emotional rewards for years. A $500 monthly spending habit feels emotionally satisfying now. A $500 monthly investment habit feels emotionally invisible for a long time. Yet over decades the long-term consequences become radically different. The important detail is not that spending money is inherently wrong. Consumption is part of life. The deeper issue is unconscious recurring consumption that quietly replaces ownership. Modern economies are structured around convenience-based spending because convenience generates enormous recurring revenue streams. Food delivery systems, subscription platforms, financing services, instant entertainment, fast shipping, premium memberships, and digital consumption ecosystems all compete aggressively for monthly cash flow. Most people do not experience these expenses as one large financial drain. They experience them individually and emotionally. $10 here. $40 there. Small financing payment. Weekend spending. Monthly subscription. Gradually hundreds of dollars disappear into systems designed to normalize recurring extraction. This creates a fascinating asymmetry between investing and spending. Consumption produces immediate visible pleasure but often disappears quickly. Investing produces minimal immediate emotional reward but accumulates invisible future optionality. Over 20 years, this difference becomes enormous. Someone consistently investing $500 per month is not simply accumulating money. They are slowly purchasing future flexibility. They are building an asset base capable of generating future income, reducing dependency on labor, and increasing resilience against economic instability. Each monthly contribution appears small individually, but collectively the behavior alters the structure of future life possibilities. The opposite process also compounds. Debt, inflation, and recurring lifestyle expansion all compound gradually over time as well. Financial systems do not distinguish emotionally between positive and negative compounding. They simply amplify repeated behavior consistently. Someone repeatedly financing consumption instead of building productive assets may unknowingly compound fragility rather than flexibility. This is why financial outcomes often diverge dramatically between people who initially appeared economically similar. Small recurring differences become amplified through time. One person gradually accumulates productive ownership. Another gradually accumulates higher consumption dependency. The divergence feels slow initially, then becomes increasingly visible later. Historically, this pattern has existed in nearly every economic system. Merchant families reinvested profits instead of consuming everything immediately. Landowners accumulated productive assets while others consumed temporary status symbols. Industrial wealth often came not from spectacular income spikes but from consistent reinvestment across long periods. Modern investing simply digitized the same principle. The psychological challenge remains unchanged. Humans are naturally present-oriented creatures. Immediate rewards feel more emotionally convincing than distant possibilities. This tendency made evolutionary sense in unstable environments where survival depended heavily on present resources. But modern financial systems reward long-duration thinking disproportionately because compounding multiplies consistent behavior across time. The difficulty is that the reward structure feels emotionally backwards. Early investing requires patience during periods when visible progress appears weak. Consumption feels rewarding immediately even when long-term consequences remain hidden. This is why wealth accumulation often looks boring while it is happening. Most financially resilient people do not experience constant dramatic breakthroughs. Instead, they repeat relatively ordinary behaviors consistently for very long periods. The power comes not from intensity but from duration combined with compounding mathematics. A person investing $500 monthly for 20 years is essentially converting time itself into an economic asset. Each year increases the productive power of previous years. Eventually the portfolio begins generating amounts that would have seemed impossible during the early phase. That psychological difference matters enormously. People who build assets gradually begin thinking differently about time, risk, work, and optionality. They stop viewing money purely as a tool for immediate consumption and begin viewing it as stored future autonomy. Financial resilience becomes less about appearing wealthy externally and more about reducing vulnerability internally. This creates another strange modern paradox. Many high-consumption lifestyles appear financially successful on the surface while remaining structurally fragile underneath. Meanwhile, many long-term investors appear relatively ordinary externally while quietly building substantial resilience internally through accumulated assets. The modern economy often rewards visible consumption socially while rewarding invisible ownership financially. That tension shapes much of modern financial psychology. $500 per month therefore represents more than a budgeting question. It represents repeated economic direction. Over 20 years, recurring decisions quietly determine whether money becomes temporary lifestyle stimulation or long-term productive ownership. Neither path feels dramatic at first. That is exactly why the outcome becomes so powerful later. Most people underestimate long-term investing because they emotionally evaluate compounding during its slowest visible stage. They see small balances and modest early growth, then assume the system itself lacks power. In reality, exponential systems always hide their strength early. The first years build the foundation. Later years reveal the acceleration. And perhaps the most important lesson hidden inside this math is that financial freedom rarely emerges from one extraordinary decision. More often it emerges from ordinary decisions repeated consistently while almost nobody notices.